Silver didn't just go down today. It broke, fast, in a way that does not match normal supply and demand. Trading screens showed sudden fractures, volume spiking, bids vanishing, and price gaps that looked more like a trapdoor than a small step down. Right before the fall, one quiet change hit the system. The CME raised margin on silver futures, turning normal leverage into a danger switch. The same signals have appeared before in big silver crashes, in 2011 and 1980. Strong moves cut short right after the rules changed. So is this really risk control, or part of a repeating pattern where paper rules push the price more than real metal in real hands? If you want to know what actually happened, who got hurt, and what this could mean for the next move in silver, stay with me, watch the full story, hit subscribe, like this video, and support the channel so we can keep digging into the parts others ignore. Follow the trail, because the evidence around IT struck again. CME margin hike triggers a silver sell-off. Here's what actually happened is becoming impossible to ignore. The shock began with a number on a screen. The CME quietly raised the margin for silver futures, the cash that traders must post to hold a contract. In a normal market, this should be a speed bump. This time, it felt more like a roadblock. Minutes after the change, price action turned hostile. Silver futures, which had been climbing in a strong, almost emotional rally, reversed sharply. Candles grew long, spreads widened, and market depth thinned. It looked less like calm profit-taking and more like someone had pulled a fire alarm in a crowded room. The official reason was familiar. Risk management after high volatility. We have heard this before. In 2011, during the famous silver spike above $40, the exchange raised margins again and again in a short window. Each move drained leverage, forced sales, and turned a boom into a crash. The pattern is simple. First the surge, then the hike, then the flush. What stood out this time was the timing. The hike hit just after retail interest and social media chatter peaked, when small traders were most excited and most leveraged. Volumes surged exactly as the new rules kicked in, a strange overlap that raises a quiet question: who had prepared for this and who had not? Margin works like oxygen in a fire. Add more and flames grow. Take it away and the blaze dies fast. By raising the cost of holding silver futures overnight, CME was removing oxygen from a crowded trade, forcing weaker hands to sell into a falling market. Seen alone, this could be an unlucky coincidence. Placed next to past moves that stopped silver rallies cold, it looks more like the first clear signal in a much larger pattern of control. And this time, the stakes around silver are even more global. To understand what just happened, we have to look back at other times silver was stopped in its tracks. This is not the first time a fast rise met a sudden margin wall. In 2011, silver ran from under $20 to almost $50 in less than a year. Excitement was everywhere. Then the CME raised margins not once, but 5 times in about 2 weeks. Each hike forced more traders to find cash or close positions. Within days, silver fell more than 30%. A classic boom turned into a sharp bust. The official line again was risk control, but the timing still stands out like a fire drill called right at the peak of the party. Go further back to 1980, during the Hunt Brothers episode. Silver spiked as they tried to corner the market. The exchange changed trading rules and hiked requirements. The price collapsed. The message was clear. When silver gets too wild, the rules can change faster than traders expect. The pattern is simple but powerful. Strong rally, growing leverage, then sudden margin hikes that act like a trapdoor. One irregular detail keeps showing up. Hikes often arrive after several days of rising prices, not before the move starts. It is like placing a speed bump at the end of a cliff road, not the beginning. The open question is, who feels the most pain each time? Are these moves mainly hurting small, late buyers while larger players adjust in advance? When we place these old events next to the latest hike, they start to look less random and more like chapters in the same playbook for controlling silver's biggest moves. Inside the CME system, a margin hike is not just a price tag change. It runs through the futures market like an electric shock through metal wiring. Every trader who holds silver contracts must now post more cash or safe collateral to keep their position alive. Clearing firms stand in the middle of this system. They guarantee trades between buyers and sellers, so they watch risk models like a heart monitor. And when volatility jumps, the models tell them, you need more protection. That message becomes a higher margin, pushed onto clients with very little warning. On paper, this is simple risk control. In practice, it can turn a busy market into a forced sale event. A trader who is already using most of their cash now gets a call. Add funds by the close, or we cut your position. If they cannot pay, contracts are sold into the market at whatever price is available. History shows how violent this chain can be. During the 2008 crisis and the 2020 oil crash, sudden margin changes helped turn bad days into historic collapses. Once selling starts, prices fall, which makes risk models demand even more margin. It becomes a feedback loop like a row of dominoes that never had a chance to stand back up. One irregular sign this time was how quickly liquidity thinned just after the hike. Bids disappeared faster than normal. Was this simply machines pulling back, or did some players know the stress test was coming and step aside? As with earlier silver shocks, a rule meant for safety may have acted as the hidden trigger that pushed weak hands over the edge, feeding the larger pattern we are tracking. When the new margin rules hit, not everyone felt the same pain. The hardest shock landed on traders using high leverage, small speculators, aggressive funds, and anyone who had chased the rally with borrowed money. For them, the hike was like the ground suddenly dropping under their feet. Position data after past silver sell-offs shows a clear pattern. Small traders and managed money funds often see their long positions cut sharply right after margin changes. At the same time, big commercial players, such as bullion banks and producers, usually see their net positions improve. The 2011 wipeout followed this script. Late buyers were forced out, while larger players used the collapse to reduce risk at better prices. This time, early numbers pointed the same way. Leverage-heavy accounts showed steep position cuts within days. Some large traders, however, hardly moved at all, or even increased positions during the drop. That is the irregular detail. Why were some able to stand still or quietly buy, while others were squeezed out? The analogy is simple. A sudden storm hits a harbor. Small wooden boats sink first, while large steel ships bend but stay afloat. The storm is the margin hike. The wooden boats are the highly leveraged accounts. One open question hangs over the tape. Did certain institutions see the margin risk building and adjust early, or did they simply react faster once the rules changed? The pattern of who loses and who survives ties back to the larger story. Each silver shock seems to shift metal and paper, claims away from weak hands and towards stronger ones, raising doubts about how neutral these risk tools really are. While silver futures were falling hard after the margin hike, the world of real metal began to tell a very different story. Dealers reported strong buying, not panic selling. Premiums on coins and bars, the extra cost above the market price, started to climb. In some shops, popular products went on back order even as the quoted silver price dropped. This is the split between paper silver and physical silver. Paper silver is made of contracts, promises, and claims, futures, some ETFs, and unallocated accounts at banks. These can trade in volumes many times larger than the actual metal sitting in vaults. It is like selling more concert tickets than there are seats in the hall. Most of the time, not everyone shows up at once, so the system works, until too many people ask for a real seat. We have seen this pattern before. In 2008, silver's paper price crashed under $10, yet physical coins became scarce and premiums soared. In early 2020, during the COVID panic, futures prices fell sharply, but the U.S. Mint and major dealers struggled to keep inventory. The official chart showed weak demand. The real-world shelves showed the opposite. An irregular sign now is that some exchange and vault inventories have been slowly drifting lower or shifting from available-for-sale categories into long-term storage, even as the futures price suggests comfort and surplus. If silver is supposedly unloved, who keeps taking the metal off the table? That unanswered question links back to the broader story. Margin hikes hit the leveraged paper players first, forcing them to sell claims. Patient buyers of physical can quietly collect real metal at discounted paper prices. Each cycle deepens the gap between the price on a screen and the true tightness of the underlying market. When silver broke lower after the margin hike, other markets began to send quiet signals. Gold slipped, but not as hard. The gap between gold and silver, the gold-to-silver ratio, jumped quickly, like a rubber band snapping back. That move has shown up before when stress hit silver first and hardest. In 2013, during the big smash in precious metals, silver fell more than gold, and the ratio spiked in a similar way. Back then, it marked a shift from risk-on excitement in metals to a safer, slower mood. The same pattern now raises a question: is this only a silver story, or an early warning of changing risk appetite across the board? Bond and dollar moves add more clues. As silver sold off, the U.S. dollar index began to firm, and demand for treasuries, the main safe bonds, ticked higher. In past crises, like 2008 and early 2020, metals, stocks, and risky assets dropped together while the dollar and treasuries rose. That mix often means one thing: people are scrambling for cash and safety. Yet one irregular detail this time is how calm some risk measures stayed. The VIX, a popular fear index for stocks, barely reacted compared with the violence in silver. Major stock indexes did not panic. Some even edged higher. That calm surface makes the silver storm feel more targeted, as if pressure was released through one valve while the rest of the system stayed controlled. It is like seeing one pipe in a building shaking while the others look steady. Is the problem inside that single line, or is it just where deeper stress finally shows? The answer links directly back to our main trail. Whether these margin-driven silver shocks are isolated market events or tools used during broader liquidity shifts that only a few players fully see. The pattern now lies in clear sight: a strong rise in silver, excitement building, leverage piling up. Then a sudden rule change from the exchange. Cash demands jump, weak players are forced to sell, price breaks, and large patient hands are left to pick through the rubble. We saw shapes of this in 1980, again in 2011, and in later sell-offs when raised trading costs turned heat into collapse. This latest event adds new layers. The timing lined up with peak retail interest and loud online chatter, just as in recent meme stock battles. The futures price fell hard, yet real-world demand for coins and bars stayed strong. Other markets remained strangely calm. It is like watching one room in a building shake while the rest of the halls stay quiet. Something local is moving, but it may still be tied to the whole structure. The odd calm in wider fear measures is an important irregular sign. If this were a full crisis, stocks and credit would likely scream louder. Instead, pressure seems to have been pushed into a smaller corner, silver futures and the traders most exposed to them. That detail leaves a question hanging in the air. Are these rule changes simply blunt tools for safety, or are they now part of a quiet playbook for steering where and how stress is released? Think of the market as a chessboard. Most pieces move slowly, but one piece keeps getting knocked over at the same time. In the same way, at some point you have to ask whether it is clumsiness or a hand guiding the game. This is where silver now stands. A repeated target in moments when leverage, trust, and real metal all meet. The trail leads to a larger truth about how modern markets work. Prices on a screen no longer reflect only simple supply and demand. They also reflect who controls leverage, who can change rules without warning, and who has the balance sheet to survive those shocks. Silver's latest break is a sharp case study in that hidden power structure. We have seen similar patterns during past turning points. In 2008, liquidity rules and margin calls turned a housing crisis into a full credit crash. In 2011 and 2013, rapid changes in trading terms helped flip precious metal sentiment almost overnight. Each time, those closest to the plumbing of the system saw the stress first, and often walked away in better shape than retail traders who trusted the headline story. The irregular gap between paper and physical silver is the quiet alarm that has not stopped ringing. Real metal keeps drifting into long-term hands while futures markets swing wildly. It is like a warehouse that looks full on paper, yet trucks. You just keep leaving at night. If that continues, one future shock may not end with only a price spike or a sharp drop, but with real shortages and broken promises of delivery. The open question is not whether there will be another stress event. History says there will. The question is where the next fault line opens, in metals again, in currencies, or in credit. The evidence from this episode suggests silver will stay a preferred release valve when the system needs to force fast selling and regain control of mood. For anyone watching, the message is simple but uneasy. The script has not changed. Only the stakes have grown.